Hello and welcome to a brand new show of Market Makers. My guest on this edition of Market Makers is someone who's known for his big and contra calls. He has predicted many booms and many busts. Even though he's referred as the mighty bear on the street, Shankar Sharma maintains that that is just figment of media imagination. Shankar, delighted to have you back on ET Now. Thank you for joining us.
Thanks.
Shankar, for the moment, India seems to be the market of choice for global investors. It is the hot favorite. Do you think there is too much of excitement? And is this excitement really warranted?
I'll tell you something. Back in 2010, 2011, there were a lot of stupid opinions out there, particularly from the global investment banks, wherein people were saying that out of the brick, India stood for I, that should be replaced by Indonesia.
Yes, I remember that one.
Do you remember that? And I said, this is rubbish. India will be a standout market relative to the BRIC pack, relative to the emerging markets pack. Go back from 2010-11 and see India's performance versus Russia, versus China. Forget China's last 6 months, but before that, look at our performance versus Indonesia. India has been a standout market actually from a very, very long time. Over a period of time, you will have some periods when India will be flat, wherein we start to say, hey, it's not doing well, but relative to the world, we are still doing well. Now what has happened is India has obviously resumed the bull market. We started in 2004. It topped out in 2008, fell, as along the world. Now it is again resumed on that upward path. And there is one simple reason for that. There is no complicated reason, and that is that oil is at 45. One reason, there is no other reason. The rest are all manufactured reasons. There's one reason, which is also manufactured by God, nothing to do with us, which is now the central point underpinning India's bull market. And oil at 45 changes so many problem situations for India. From a current account deficit perspective, from an inflation perspective, from interest rate perspective. So it is just, as I've always said, India is a country that runs Bhagwan Bharose. We have 33 crore Devis and Devtas. So they said, okay, so you've suffered $110 oil, now you deserve $45 oil. And we've got it.
Well, those 33 crore Devi and Devtas were there when the population was 33 crore. And hopefully that list could also expand.
I think so too. Yeah. Looking at the number of godmen, I'm sure it's a lot higher.
For the better part of 2014, we've been very inward looking. We've talked about our macros, our problems, the fact that we have a new leadership in place. But can we close the eyes to what is happening in the world? The fear of deflation for global economy is real. And global markets are only moving on, or global economy is only relying on one engine, which is US.
See, I always believed that, global macro should be paid a lot of attention to. I mean, we can always look at India's micro and say India's X and Y. But deflation is a genuine issue. Look at long-term bond yields, not just for US. Look at it across Eurozone. I mean, Italy's 10-year bond yields are like 1%. You have Portugal at about 0.5% or 1%. You have France at about 0.6%. I mean, what does that tell you? These countries are not robust economies, but people are willing to lend them money for 10 years at 1% or less than 1%. That is clear deflationary situation building up. All the yield curves are also getting increasingly inverted. So that's the other problem. So equities in deflationary times typically don't do well. Because in inflationary times, it's a good hedge against inflation. Manufacturers have pricing power to raise prices, right? So when you raise prices, hopefully you should capture some extra margin coming out of the price increase. Deflation is typically bad for equities. But there is only one market I can think of where it is good for equity, which is India. Because we are a chronic inflation sufferer from the time I have been born. We've always suffered at the hands of inflation because we have too many mouths to feed and very little productive capacity. Because of the global deflation, again through a pure act of God, a good act of God, it ends up benefiting India. That we like deflation. India will love deflation because it will lead to our interest rates softening by quite a lot. Remember, world has been cutting interest rates from 2009, right? We are about the only country of the major economy which has gone the other way. So there is a big gap between our interest rates and global benchmarks. That needs to collapse. And I think the collapse will happen because Indian interest rates, we can fall by like 200 bips, maybe 300 bips over the course of the next 2 or 3 years' time. Because I don't think inflation is a problem given the global deflation situation and a strong dollar for to add to that.
Before I get into specifics about India, let's address oil. And there is chaos in that market. world's biggest commodity has seen a 50% drop. Could that lead to some degree of financial adjustment going forward, maybe political as well?
Look, I've always believed one thing, okay, that's been an overriding belief. And there was again a lot of total, utter nonsensical talk of global commodity super cycle from people like Goldman Sachs and Jim Rogers, etc., that it's the secular bull market, never come back. I have never bought that theory because my view is this: all bull markets are good for society. Stock bull market, bond bull market, real estate bull market. It benefits, enriches everybody. There's only one bull market that is bad for society, and that is a commodity bull market. Because 90% of the world is a consumer of commodity, 10% of the world produces commodities. So it impoverishes, it makes poorer the rest of the world at the hands of a few oil producers or a few aluminum producers, steel producers, iron ore producers. So the world will always resist a commodity bull market, and it will keep finding ways to puncture commodity bull markets. But it will always find ways to perpetuate stock bull markets and bond bull markets. That is the reality. So hence this was the pure cyclical bull market we saw from 2003 in commodities that came out of basically China's big demand. I think that's gone. China will never consume commodities at the same pace ever again. So commodities on a secular decline. I'm very, very convinced. I mean, for a long term, you will not see the prices of any of the commodities going back to those levels. And in light of also a strong dollar. So my view is that commodity disruption is just the beginning of the end of a commodity cyclical bull market. It wasn't a structural bull market. And which is again, rightly, wrongly, great news for us.
But are we somewhere underestimating the impact of China, because China has been the source of growth for global markets for nearly a decade now?
For commodities.
In general, China's contribution to global growth has been strong.
Because it has been such a big consumer of commodities.
Okay.
It has been at the margin, the sole, 80% of the demand has come from China. So for an Australian economy, for a Brazilian economy, China has been the economy that has made them. Now those economies are hurting. You look at the Aussie dollar, that lost like 3.5% last week. You look at the Brazilian real, it has fallen by like 18% in the last 4-5 months time. So there are economies that will be hurt. So Middle East economies will be hurt, Australia will be hurt, Brazil will be hurt, but those are minuscule compared to the sufferers of a commodity boom. India being one, Western economies being a huge block. So I think overall the world will be better off because of a commodity bust, but there will be pain felt by the guys who are producing those commodities. But that is they had a party for 10 years, boss. So come on, it's okay.
It's all about cycles, isn't it?
Yeah, exactly.
So let's talk about India. Like you said, that India is the only large economy where earnings are likely to move up, inflation is down. But what about valuations? The Sensex, as we speak, is now trading at 16-17 times based on FY16 estimates. Trailing P multiples have gone north of 20.
I have never believed in valuation as being the determinant of when a market gets overheated or underheated. At extremes, if you're talking 40, 50, 60 times earnings as in 2000, that's a different issue. But there's nothing to say why 17 is good and 20 is bad, and particularly in light of one simple fact that are we underestimating the extent to which Indian interest rates can come down? That, to my mind, is central. In making a valuation call, let's first make a call on where we see the 10-year bond yield in India coming down. Do we see it at 7%? Do we see it at 5%? Do we see it at 4%? 3 years out? My call is you will definitely see between 5 and 6% in the next 2 or 3 years' time. Now you do the math that if bond yields go down by 40%, then should this P multiples then be re-looked at as to what is a fair value multiple? So that's why I'm not a big believer in just looking at P multiple and making a judgment on overvalued or undervalued. Look at the interest rate in India, and do we think there is huge scope for it to contract? My view is yes.
So if your view is that interest rates will come down, bond yields will contract more, consumer spending is going to increase, how should one participate?
I think the consumption plays, whether it is auto or whether it is a Hindustan Lever, they all look very, very good to us because they have done okay even in pretty bad times. So it's not as if they have been hit hugely, that they've had a negative volume growth of like 20% or something. They have been flattish or -3%, +2%. That's the kind of number you've seen. With inflation going down, and you see the hiring cycle has been quite strong in India. Salary hikes have come back very strongly in the last year and a half because of e-commerce largely and technology. But ultimately the same talent pool. So when you go to an IIT to hire, everybody is going there, whether it is a financial services guy, e-commerce guy. You to hire the same set of guys, and everybody is now getting pretty strong packages. All that will feed it, and with the lower inflation, higher salary hikes, ultimately consumption has to make a comeback. Might be 2 quarters down the road. When that happens, you will see people again going back and buying a lot more cars and bikes. People going out and buying more non-durables from the likes of a Lever and other FMCG players. And so these companies, for instance, the FMCG players, they've been hit by simple lack of volume growth, and that is a fact.
Yes.
They have only relied on price hikes.
Q3 numbers were not impressive at all.
Not at all, not at all. But I think you have to look a little bit beyond that and see that with a 15% salary hike, with inflation just being at 3%, you're getting an extra 10% disposable income. This is a broad number. This is not a very scientific number, but let's say this is the number. That has to flow to all these guys. So you may not see price hikes driving growth. You might see volume growth coming back to these companies.
I want to specifically talk about HUL. You've liked HUL in the past. You still
we
like
have liked
HUL.
and disliked. So look, I've been around for 26 years. There's no permanent like or dislike.
Okay. So as of now, you like HUL.
As of now, we like HUL.
Let's not talk about valuations. I'll talk about market capitalization, 2 lakh crore. And some would argue that HUL is a great company, but is someone paying the price of gold to buy into silver?
I think that's a very complicated question. But my view is, again, these companies have always been expensive. Go back to 94, 95, they were 60, 70 times earnings. Indian shaving products, Gillette used to be 125 times earnings. India will never give you quality stocks at 5p. These are quality stocks in the broad sense of the term, that they are high ROEs, free cash flow, etc., etc. They might be expensive, but again, we have to look a little bit down the road. That are we again at the cusp of a reasonable resumption of the consumption cycle, which paused for 2 years in India. It was very strong from 2004 onwards till 2011 or so. 12, 13, big pause. Again, we are resuming that on the back of lower inflation. Well, if you factor that in, I think they will still remain expensive. I think they're going to be very strongly outperforming the markets.
So you think HUL, Asian Paints, Daburs, the ITCs of the world have a long way to go?
ITC I'm not so sure of. That's a little bit of a different kettle of fish. But the other three that you mentioned, and some others as well, I think those are a good spot. Autos look like a good spot as well, because they again are part of the same consumption basket.
And Maruti is the first port of call there?
Yeah, absolutely. That we have liked for a long time. From the time they had this strike problem and all that, and from there it has been a big performer. But we have liked even the two-wheeler companies.
So as we speak, Maruti is north of 3,000. Yeah. On a 3-year basis, do you think this could be a 5-digit stock?
As in, okay, yeah. Yeah, definitely. I think maybe 7,000, 8,000, and who knows?
So the big upside, according to you, in autos and consumers' name is still left. The party has just about started.
Because of lower inflation.
Okay.
So let us not discount that simple fact.
Which no one was factoring in about a year ago.
We could not. Nobody could have foreseen all 845.
And according to you, there is no frenzy, there is no euphoria in consumer and autos.
Well, definitely not in autos. Lever has done quite well lately, but I don't think it's frenzy, in the purest sense of the word. So I think market is probably looking a little bit ahead rather than most of us are. I think that's what we need to do.
You've not liked banks in the past. Has that view changed?
No, again, we have liked and disliked and liked and disliked. So
okay. As of now, what is the status?
As of now, lower interest rates good for banks. Again, not a big rocket science thing. I'm not bullish on the fact that they are very cheap or they are looking as if they'll keep growing 25%. I don't think that's going to happen. But simple readjustment rate for bond yields at 8% going to 6% over 2 years, obviously large part of the PSU pack will benefit strongly, and lower interest rates in any case are going to be beneficial for credit growth also. So it's a good place to be.
So in the short term, can PSU banks outperform private banks?
They can. Again, those are harder things. For that, you need to be very trading oriented. I'm just saying, as a pack, because of the simple fact of lower long-term yields, and hence that will boost lending as well as bond portfolios. I think by and large banks are a good place to be.
What about credit growth? Credit growth is not bank. The sentiment is strong. Opinion has changed, but the real demand is yet to pick up.
I agree, and I don't think credit growth in aggregate is going to pick up a lot, because that large consumers of credit are not guys buying stuff fridge and washing machines. They are large parts of the big industrial companies, and I don't think the industrial part of India is looking good or will look good, be it the power sector or be the infrastructure sector or the metal sector. I'm not at all bullish on that, those spaces.
So the industrials and cyclicals as a group have a long way before they recover.
Yeah, I mean, my bullishness on India has nothing to do with bullishness on core industries. My bullishness that my view is, look, India will never be a manufacturing giant. I mean, I'm very clear about it. So we should stop looking at, I mean, there will be isolated cases like pharmaceuticals or autos, but they have been there for 25 years, nothing to do with a particular change in the regime in the center. But I'm saying if you compare us to a big manufacturing giant like China, we will never ever get there. And that's fine, I'm happy for that, because manufacturing, nobody makes money. Money is made in services and in branding. India should focus on that. We are good at it, we'll make a lot of money doing that. But hence I don't like the manufacturing end of the market, or the sector that was supposed to have been benefited by a change of the government, like your infra, etc. I mean, we have never liked them for the last 3-4 years. We liked them in 2004 when they were beaten down, but I don't think there is much there.
So what is the sitting duck trade as we speak?
I mean, the world's biggest consensus right now is that US will outperform emerging markets. I mean, it's an article of faith. Exactly opposite to what 2011 was, when the article of faith was EMs will outperform US. It has changed. I think the trade has now begun to change, that the US will underperform EMs sharply. I wouldn't be surprised if the US falls 10-20%. I wouldn't also be surprised that India and China outperform vastly. China, could be, in the next 2 years' time, could be like 20, 30, 40% higher. I think India won't do as well as China, but India will still do well. India could be 15% higher a year from now. I think it's a two-horse race as far as, of the large markets. I mean, Philippines is doing very well, but that's a small market. Of the larger markets, it's a simple two-horse race. India and China looking very, very, very good. I mean, we are very bullish on both of them. We've been bullish on China from last year, July, August. It's been up 50% from there. Whoever cared to listen on the FIS side, made a lot of money. We still think, there is a lot of upside room. By the way, US economy is also not as strong as people think it is. I mean,
5% for the quarter gone by.
No, but 5% out of that, 80% of that growth was contributed by the increase in net exports. Not because exports went up, but that's because the imports came down. Import coming down is not good for the economy. And $40 oil is not necessarily good for the US. Because look at the data, almost all the job growth has come from the states producing oil. So US is actually more of an oil economy than any of us cares to think. Large part of the consumption, job growth, lot of things have actually happened in the states producing oil. So it's not aggregate data. Look at state by state data. It's come from states producing oil. So oil at 40 is not necessarily a boon for the US numbers.
Yeah, 1/3 of the incremental capex growth which came in last 5 years for US actually came from the energy sector.
Exactly.
So big question mark there going
Exactly.
forward. Let's talk about oil marketing stocks. The first port of call when oil drops is to buy oil marketing stocks. Yeah. 2014 was a great year for HPCL, BPCL and IFC. Is that trade over now?
I mean, now oil has reached a place wherein, now incremental moves obviously can't be 60%. But I think, look, these stocks are not buy and hold stocks. These are big, if you take a bet on oil, you have to take a bet on them. Take the bet. If it works out, great, but don't think that that's a move that you will continually keep seeing. So for now, the move is over. We will see, again, if they really reach a point wherein, again, oil goes back to 65 or something, which it can, it's fallen so much, you never know. From 45 to 65 is not a big journey. Then again, these guys will take a beating. But I think oil trend is broken. So at 65, again, you might want to re-enter, the OMCs.
You like Sun Pharma, Lupin for the longest time. Are you still a buyer there?
I think these guys are good. So are the IT guys, by and large. Despite everything, the rupee is still 61.5. It went to as low as nearly 64. That is, again, not sitting well with the overall data, or at least oil prices at 45. I think over the next 12 months' time, there is a very good case for the rupee to drift back to, beyond 62, 62.5. Once you go beyond 62, it could be 63 or 64. Because I don't think the dollar is going to weaken against most currencies. I think dollar is on a secular breakout. So given that, I think you still need to have some dollar hedges in your portfolio.
So IT and pharma should be...
IT and pharma, autos are also reasonable because quite a few of them have reasonable exports.
In general, what do you make of the price action in the small and the mid cap space? Now, without getting into the argument of PE, the price action has been quite extraordinary.
Yeah, but we have been bullish on them for about a year and a half now, right from the fourth quarter of 2013. We've liked small mid because they have been really, really crushed here, and they were good companies. And fortunately, they are not very many people get interested in them from the institutional set, which means you have a lot of time to analyze them and figure them out. And you don't need to do 100 of them. You need to have like 2 or 3 or 4 of them. I still continue to think that's a good space to be in. It's a good space to be in.
There is a lot of excitement in and around 2 themes. First is digitalization, and second is e-commerce. What do you make of these 2 big popular themes?
No, I think they are secular themes. I mean, I'm very clear that newspaper readership, newspaper circulations in India are going to be mirroring what has happened in the world. We can't again go away from that trend. I think you will see drops from here on, for the next decades. Forget about years. I mean, I rarely read a newspaper now, other than if I don't have a choice or I don't have mobile connectivity. Otherwise, always on my mobile phone. And I'm sure that's being replicated across mobile phones, smartphones in India. So secular decline in readership in the physical paper, hence advertisers will obviously go more digital. I think it's a tsunami. I mean,
what about e-commerce? How should one participate in this opportunity?
I mean, people are participating, people are paying amazing valuations for e-commerce plays, and I'm sure they know something that we don't. But obviously through the listed space, the way we have liked it is obviously the logistic companies. So Gati we have liked. Blue Dart has been terrific as well. And so there's a limited approach into the listed space to play e-commerce. But I would rather play it this way rather than go out and buy companies that buy a television at 50,000 and sell it at 25,000. So that somehow doesn't look logical.
As we speak, the sentiment, the outlook, the mood point is on our side. But by the time we'll wrap out of 2015, what kind of Nifty level or the Sensex level do you think we could be staring at?
And that I really have always desisted from making those kind of calls. Directionally, I think we should be up, but whether we are up 10% or 15%. Again, weighing down the aggregates have been big losers like Reliance. I mean so your Nifty etc. is masking. It was 1,700 rupees and now it is 800 rupees. I mean, who could have said that in Nifty will be at these levels and Reliance will be half? Of course, our view has been on Reliance very consistent for many, many years.
Has that view changed?
No, it cannot change it.
So Reliance still runs the risk of underperforming?
It's not a risk anymore.
It is underperforming.
It is underperforming. So we haven't liked it for years now. And I keep reading in the paper the brokerages are bullish, and I see no reason why people should be so.
So the script of how Indian markets will move now will be a function of inflation and low interest rates, and what has worked in the past, which is consumer IT and consumer IT and pharma names, they will continue to chug along.
No, and domestic play. So banks are also a domestic consumption play, in some senses, and your FMCGs are the same. But I'm not going back and buying all the really troubled sectors. At some point, I might think of looking at infra as a trade or power as a trade. We'll see. But right now, let's not get there. I mean, there are still good enough plays in what has been working. Apart
from Maruti and HUL, anything else you like from the large cap space?
All these. I mean, Hero Motors is good. TVS is good. It's a whole category. You can pick and choose, and you'll
bet on the consumer. That seems to be.
I think that is a big trend. Rates are too high in India. They have to mirror longer term global rates, and we will see 5% on the 10-year bond yield in 2 or 3 years' time.
Right. Shankar Sharma always wraps up the show in his charismatic style with a big call, with a contra call. What is that big idea for 2015?
I think people are going to lose money in the US and make money in emerging. Exactly opposite to where everybody is positioned.
Gold long or short?
Gold is a short. Inflation off the table. World is trying to bring back inflation. So what's the case for gold?
But in general, it is time to stay invested, and if you've not taken the plunge, it is time to jump in now.
I think there is. It's not too late, at 29,000. Be a little bit careful. I always say that irrespective of where the markets are. But I think we are still on a good wicket here.
Watch your steps because of budget, or budget is just a one-day affair, maybe more like a 100-point Nifty affair.
And that's always been the case. I mean, that's really your job to build the hoopla. I mean, I don't blame you, right? But other than that, it's forgotten 3 days after the event.
But we look forward to meeting you on the budget day.
Sure,
appreciate your time. Thank you for joining us.
I'll be there.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.